JB says, can you compare returns and success rates of covered calls, married puts, and collars? Annualized returns if possible. So we're talking about three different strategies. We're talking about a covered call structure. Naturally, just buying the stock, selling the call against the security, whether you're at the money, out of the money, or in the money. In general, we prefer to be in the money. Covered call approach for us is we're not married to the stock. Okay, we're looking to be assigned, make the maximum return with a high probability. We're commonly going to use in the money covered call positions for that higher probability of signed and earning that return. We're not looking to hold the position necessarily long term. I'll explain that in a moment. But if you look at our monthly picks of the day or weekly picks of the day, you'll see that most of these positions are in the money. GGAL at 49.02. We'd look to sell the 15th of November 44 call for a midpoint of around 610, which would give us about a 12% downside protection and a 2.5% return if assigned. But since we're about 5 points in the money, we're probably looking at a 70-75% of being assigned and earning that return. Dave and Buster's at 38.27, selling the 34 strike, 427 in the money for about 510. Again, another 2.5% return for about 30 days, JB. And probably still around the same probability, probably 68-73% of being assigned and earning that return. We're not looking to manage the position. We'd be called out on this. We take the 2.5% return in 28 days and then look to open new positions. Weekly, very similar. In the money positions, Monster at 211, 197 October call for next week, midpoint of around 1940 for a 9% downside protection. And SMCI, of course, a little bit more volatile positions, as you can see, 47.50. The October 45 call for next week, midpoint around 370, almost an 8% downside protection, how far the stock can fall before you start losing money on the position, and a return of 2.7%. That's the covered call approach, of course. That's the in-the-money covered call approach. That's what we'd prefer to do. Because the reason why you're seeing these on the picks of the day is because Ernie, when you click on the link here that says see how we developed these results, Ernie walks through what his testing cycle was and what he did over selected time frames of up and down markets, as you can see here. It's a long time ago, but in up and down markets, he tested about 45, 50, possibly even 55 to 60 different iterations of covered calls, looking at technicals, fundamentals, looking at in the money, at the money, out of the money, high volatility, low volatility, avoiding earnings, not avoiding earnings. The full description here is what he's looked for. And found out that using in the money covered calls, of those, let's just say 50 possible iterations run over that time frame, the in the money covered calls gave the best return over that time period with the least amount of losses that take away from that. So in this case, the average return on the winning trade was 2.3%, and he made 24% in a year using the in the money, picks of the day. So let's just jot that down, 24%. Some years it's going to be better, JB. Some years it's going to be lower. But you can see the time frame, the chart here. I know it's very small, but the chart here of a neutral to down to back up to big down to big rise, different market iterations where this panned out to that 24% return on an annualized basis. The collar spread, long collar. Of course, similar to a covered call, but we wouldn't be looking in the money covered call, JB. We'd be selling at or just out of the money, and we'd be buying a put at the same time that's at a lower strike price and a lower premium to still get the initial net credit. In general, you're looking monthly at maybe a 2.5% return if assigned, with only about a 45, 50, maybe 55% probability of being assigned and earning that return. Got to be much stronger in different markets. But at the same time, you've cut your loss in that 20, 14, 30-day time frame to only about 4, 4.5, or 5%. So similar returns to the covered call, but with a lower probability of making that return, but guaranteed protection, better than a stop order if the stock moves against you and falls the unprecedented event of 12, 15, or 30%. You still are guaranteed to only lose 4.5%, whereas in a covered call, if it's a sudden overnight movement, a drop of 15 or 20%, you put in your 5% stop order, you don't get filled at 5%. The stop order is just a market order to say, hey, if this is triggered, close me out at what the market is offering. You still get closed out at that 15 or 20% decline. Now, yes, you might have taken in that 6, 7, 8% downside protection, but that means you're still losing 7, 12, 13% on the overall position, and you've probably wiped out close to 7 or 8 previous trades, similar to what you'd see in a credit spread or debit spread approach. Standard collars, let me break on this. Standard collars, 15, 20, 30 days out in time. You're hoping to get assigned to earn the return, but you're giving yourself a protection base, a guaranteed exit better than a stop order. You are paying for it, of course. Hey, how often does a stock fall? 10, 12, 15%. I bought the stock, I sold a call, I got a 4% downside protection. It falls 5%, I'm only down 1%. I can keep rolling it. How often does it fall 12, 15, or 20%? Based on all the conversations I've had in the 20 plus years I've been working with power options, all too often, more than often than you'd expect, where investors get into trouble and then have to try to repair the position, usually using the stock repair tool here on Power Options, JB. If I use a standard collar approach, it's on a stock that I'm bullish on in the shorter term, 15, 20 to 30 days. But I'm concerned about activity in the market, upcoming events, known upcoming events with an unknown outcome, earnings, election, global strife, global conflict, storms, intensified storms, things of that nature. So that's when I would use a collar position where I like the stock, I'm hoping to get the good return, but at the same time, I'm uncertain about what's going forward, and I've been burned with covered calls recently. My personal experience, JB, is that when I first started working with power options and first started trading, I opened an account at Options Express. We had a link with them. It was one of the new ones that came out. Actually, the owners of Options Express had a Power Options account before they created Options Express. And I opened my account with, I think, only about $2,400, $2,450 maybe. I can't remember the exact number. And all I could do was trade covered calls, because at that time, when you opened a new account, you were just given level 1 trading, which allowed you to buy stock, do covered calls. They didn't allow you to buy puts to do the collar yet. You couldn't sell cash secured naked puts. So for about 18 months, you had to get a record of a certain number of trades. I can't remember if it was 25, 30, or 50, but you had to get a record of a certain number of trades before they would allow you to move up to level 2, options trading. So I did covered calls for 18 months, and I essentially had the same experience that most investors had. We worked with 2 specific groups out in Texas, Financial Success Coaching, the Kim Snyder Group, and Compound Stock Earnings. And they were teaching covered calls, and they were sending our customers to use our site because it was the most efficient, still is the most efficient, but it was the only one out there that allowed you to search for covered calls that matched their specific criteria, or diagonal calendar spreads or collars. After about 18 months of trading covered calls, I left trading covered calls and I started trading these standard collars. Why? Because I had some good months where I had some good success, would get assigned, make my 2.5%, make my 3% return. Some other positions that fell 4, 5, or 6%. Okay, I'd keep rolling them. Weeklies weren't available. That's why I'm mentioning monthly. Weeklies weren't available back in those old days. So I'm just rolling month by month, maybe rolling 2 months out in time, trying to repair the position, get back to break even, get a better cost basis, and so forth. And then 15 to 20% of the positions fell. That 20 to 30%. Where it's hard to gauge, hey, I mean, I have my technicals now that I like to use, JB, but it was hard to gauge then, hey, I got a stock at $50. It fell down to $41 per share. I'd originally sold the 52.50 call, gained about $1. All right, so my cost base is $49. Now it's at $42.50. Do I roll down to the 45? Because if the stock recovers, comes back up to 47, I got to pay $2, $3 to buy back that call now because I can't get assigned at a loss. If it kept dropping, dropped down to 35, it dropped down to 30. Do I keep moving the call down saying, hey, it's not a problem, just keep rolling the call down, just keep rolling the call down, keep lowering your cost basis. But at any point in a sudden rebound, you run in that catastrophe of being locked into a loss. So after those 18 months of essentially breaking even, small profit of about 1.5% to 2%, was not achieving my goals. The promise they were advertising at that time, hey, covered calls can make you 3 to 6% per month. Don't worry if the stock falls, just keep selling, keep selling, keep selling. That's not what I experienced at all. Using the tools here, using the tools at Options Express, using other tools, it didn't work out for me. The structure of the trade, remember, is almost working against you. You're capping the upside to a small gain while still taking on 98, 97, 95% of the risk of owning the stock outright in any type of major decline. The collar sort of solved that problem. I still have a capped gain. But at the same time, I now have a guarantee for uncertain market events, black swan events, uncertain early earnings warning announcements, JB, or going through earnings where I'm guaranteed not to lose more than 4 or 5% on the position, or however I structure the trade. Naturally, if I take a lower risk of 2 or 3%, I'm going to be seeing a lower return of only 1 or 1.5%. And that worked out for me for a few years, 2.5 to 3 years. Why that worked out for me is I was fortunate enough to be right 68, 67% of the time. With that structure I mentioned, let's just take a look at the search real quick. The default search initial values, I think, is what's going to come up for us for these standard collars, JB. But I'm going to make a couple adjustments similar to what I do in my personal account if I do long collars. 50, by the way, before I get into the next part of the discussion, at this point in time, 50 to 55% of my portfolio is in married put positions or these long collars. Most of it's in the married put positions. Occasionally, I will do a standard collar position is what I'm looking at. And, but most of my positions are in the true married put. We'll get to that in just a moment. I do not trade covered calls anymore because of what I just explained. Now, some of these results that came up, some of them are smaller. I want to look for, am I on initial values? No, I'm on conversions. That was for a presentation last week. I apologize. Let's go to initial values, JB. This is the default I start with when I make a couple adjustments on the positions and the option criteria. So initially, when you go to initial values, sorry, folks, we've got, this is actually a good one. I like, that's too close. Mara's trading at 1888. This is a monthly standard collar position. We could sell the November 19 strike standard November expiration, I believe. Yeah, standard November expiration on the 15th. My apologies. Some weeklies are thrown in here. At 231, and by the 18 strike put at 191. So I'm going to get 40 cents of premium. It's 54 at midpoint, which could potentially give me a max return of 3.6% if Mara is above 19, 28 days from now. If the stock falls below 18, that's only going to give me a 1.9% loss. I want to change this up a little bit. What I want to do is look specifically, this call out of the money range of 0 to 5, I'm going to limit that to 0 to 2% out of the money. I want to be right at the money. I'm going to allow the put to be about 3% out of the money as well. I'm going to look still for a max return of 3%, but I want the maximum risk, the percentage maximum risk on my long collars to be less than 6 to start with. I want to look at sort of a 50-50 combination, but we're going to see other results that are less than that, JB. The Mara one still comes up. That seems kind of close to me. And there's a weekly one, the 8th of November here, that's a 2.4 to 3.1. That's pretty good when I'm seeing these numbers. But commonly what you see is something along this lines. NVIDIA. This is actually something I think I would get into. NVIDIA trading at 138. The November 140 call, the November 8th, just after the election, so it's important to have insurance here, priced at 550, buying the November 131 put at 335. This gives us a max risk of 3.5% with a potential return if assigned if the stock's above 140 at 3.1%. Now let me increase this things here. What I'm looking for, I thought I have probability of assigned. I don't have it. I apologize. But naturally, since the stock is trading at 138, I'm selling the 140 call. We're looking at only a 40-45% probability of being assigned and getting that return. We've protected ourselves from uncertainty, and earnings were 36 days ago, so we're not have to worry about crossing another earnings at this time, to only a minimum of 3.5%. So I'm going to isolate this a little bit more, and I'll explain why in a moment, JB. Let me clear out this other detail of the days to expiration. And I'm just going to look at standard November expiration, 28 days out in time for my call and my put. I'm going to make sure that the call put expiration dates are equal. And down here further, I'm going to make sure that the call strike is greater than my put strike. I'm going to keep the risk to be between 3.5 and 6%. And I'm going to put my return between 2 to 3%. Now, I could use in the money, out of the money ranges. I could use delta on the call and the put. But simply by putting in these return ratios, let's increase that to 3.5. We're going to get more of the structures that we want with some of the other default criteria. And this is more along the lines of what I'm looking for. Marriott, 79.36, November 80 call, buying the November 75 put, potential return of 2.7, maximum risk of 3.7%. Let's just save that very quickly. And we're going to call it October 18th, 2024, collars, standard collars. We'll just call it collars, but we'll call it standard collars. Now, we're going to come back to this in just a moment. In 2007, 2008, early 2008, a gentleman called me up who's a trial member to Power Options. His name was Kurt Frankenberg. And he says, hey, he scheduled a coaching session. The coaching session is a 35 to 45-minute phone conversation with myself or Ernie. He said, can you show me how to use your married put search tool to find put options that are 6 to 8 months out in time and are in the money? I said, oh, no, there's no way you would do that. That's a waste of money. What you want to do, if you're doing a married put for protection, you want to buy the stock, let's say at 50, you want to buy an out of the money put, say a 45 or a 40 for just 30 days out in time to pay a lower price and keep the risks around 8, 9, 10%. You won't make money with this structure. And he said, well, can your tools do it? And I said, okay, well, let me show you. Yeah, the tools can do it. We're going to build this structure, but I don't see how you're going to make money with this. And he said, oh, let me invite you to one of my webinars and I'll show you how I make money. That was our introduction to radioactive trading and the married put technique. I was so impressed with what Kurt had built here with the blueprint, the married put structure, looking for puts that are 5 to 6 to 8 months out in time, with using at that time just the 8 or 9 different income methods that he had, that I invited Ernie to join me for the next two. Ernie, who's been trading options since the 80s, 70s really, in late 70s, early 80s, was so impressed by it that he flew Kurt out here from Colorado to Delaware, met with Kurt, had him here for a few days, decided to partner up with Kurt, and eventually Power Options bought the rights to the blueprint, the full work, radioactive trading, and much more. And now this represents 50% of my trading portfolio, 55%. Why? Talked about how covered calls didn't pan out for me over that 18-month period where I was essentially at break even. I was sort of hitting my goals, and I was happy with my goals with the long collar, the standard structure, similar to what we just saved in that search we just looked at, because I was right 67, 68, 70% of the time. As you saw, and as you can imagine, JB, with that structure of the positions I just put in, if I'm looking for a return if assigned, a max return on a standard collar of 2.5% while taking a risk of 4 or 4.5%, I have to be right 2/3 of the time in order to profit on the positions. As Kurt went through the few-day meetings with us on the second or third day, he and I had an opportunity to sit down in the break room we had at the time at the office, have lunch together. We were discussing how we might handle webinars together, of him teaching his technique, me showing how to use power options, doing it in that approach. Some of you might have seen those older webinars from 2009, 2010, where Kurt and I are going back and forth and so forth. And he said, what was your success rate on your last 5 or 6 main positions? And I told him it was about 69, 68%. Using standard collar positions, I'm averaging about a 2.1% return. The positions I lost on, lost about 4.5%, didn't manage. If I win, I take the return. If I lose, I take the maximum loss. If it's in between the 2 strikes, I just re-bracket the collar for the next month. And that was my standard approach. Ernie and I wrote a book about it, actually. Protective option strategies. It's a little paperback book you can probably find on Amazon somewhere as well. We walk through different types of collar structures, calendar structures, you put further out in time than the call further out in time than the put, so on and so forth. And he said, well, of the positions that you made the maximum profit, how much did they rise? And I said, well, one of them moved up 9%, one of them moved up 7% in that 30-day period, one of them moved up 5%. And he immediately said, you'd be doing better with this. Let's take a look. And we used the historical tools and power options at that time. We looked back over the last 3 months of the collars I'd opened, the return that I took, and where they would return even without the income methods if I had just traded them as married put positions, and they were a higher return. Now, expectations. Now that I've described what we do here, now this is not going to include the income methods necessarily. Standard JB, what I expect in these positions. As you saw, the covered call default screen we went through, the monthly married put picks, or the monthly covered call picks of the day. Sorry, I'm getting confused in my own strategies. The monthly covered call picks of the day that we looked at. Ernie's testing showed a 24% return over a 12-month period within the money covered call. So you're expecting 2% per month or 24% annualized return. Standard collared positions, I'd say that using the standard collar positions 1 month out in time, slightly at the money, selling calls, buying out of the money puts, you're going to be a little bit lower than this. I'd expect you maybe around a 20% annualized return is the expectation. Because you're making still the same profit that you are here on the covered calls. You save the big losses that you take in covered calls because of that put in the standard collar structure. But oftentimes it ends up in between. And how long are you managing by re-bracketing the collar if the stock is between the strike prices, and are you lowering the return? So let's say an average of about 1.3 to 1.5% per month is the expectation if everything is going your way, JB. This is what I'm basing it on. A melt-up market, a neutral market, or a growth market. In a down market, naturally, we're going to take some of this away. But let's just say 1.3 to 1.5 on standard collars. With the married puts, what Ernie and I had experienced, and we show in the Fusion portfolio, Ernie's a little bit higher than I, but what we generally experience is 1.5 to 2% per month, or about, 20 to 24% as well. Ernie's actually exceeded the return on SPY in the past 3 years, including this year in the married put portfolio. I'm lagging him by about 2 or 3%. I'm still above S&P returns with the married put portfolio, with the married put positions, JB, but I'm lower than Ernie is. But that's the general expectation of the approach. And again, you say covered calls. Oh, people are talking about 3 to 6 per month with covered calls, and you don't have to worry about if the stock drops. That's rare. Even if you're in a strong market using out-of-the-money calls and getting a 4 or 5% return, you're getting less downside protection because you're only collecting the time value, and as the stock falls, you're going to have a larger loss that's going to wipe out this expectation. These are my expectations going forward for these strategies.